Well, it's great to be here, standing on what I guess is the New Economy Forum's answer to Pride Rock from the film The Lion King. Now, from Brexit to the US-China trade war, to Russia's invasion of Ukraine, to the bloody conflict unfolding in the Middle East, it's clear that geopolitics is back as a significant driver of global economic and market outcomes. So today, I'm going to spend a few minutes trying to put a price on the cost of those geopolitical shocks. And let's start with the US-China trade war, the moment when former and who knows, perhaps also future US President Donald Trump imposed tariffs on US imports from China. Now, my team at Bloomberg Economics waded through an ocean of data and calculated what happened to US imports of the goods where trade war tariffs were imposed, and what would have happened in a counterfactual scenario where no trade war took place. As you can see from the gap between that white line and that pink line on the between the gap between that white line and that pink line in the chart on the left, the impact is about $150 billion in lost Chinese exports. Bad news for the export factories of China's Guangdong, Zhejiang, and Jiangsu provinces. Bad news also for US consumers who faced higher costs. Let's spin the globe around and think about what's happening in Russia. Now, the sweeping sanctions imposed on Russia as a consequence of its war of aggression against Ukraine haven't resulted in the immediate cratering of the economy and financial system that many expected. But there's still a significant slow burn drag. We think the right way to think about that is through the lens of what happened to South Africa during the period of apartheid, when South Africa's growth suffered from its self-inflicted autarky, self-inflicted isolation from the global trade and financial system. For Russia, we think that means by 2026, GDP is going to be 8% smaller than it would have been if Putin's tanks had stayed on the Russian side of the border. War in the Middle East is already a human tragedy. If fighting stays confined to Gaza, the impact on the global economy is likely to be pretty limited. If the conflict expands, though, and in particular, if Israel and Iran, those two old regional enemies, start firing missiles at each other, the impact on global growth could be severe. Using the template of the first Gulf War at the beginning of the 1990s, we modeled a scenario where global oil prices rise to $150 a barrel, and there's a significant risk-off shock in global financial markets. If that happens, our models tell us that global growth next year would be lower by 1 percentage point, a drag on global GDP of around $1 trillion. In the world of geopolitical risk, though, the biggest shock has yet to occur. There is arguably no more important economy for global supply chains than that of Taiwan. Everybody from Apple with their smartphones to NVIDIA with their AI chips relies on Taiwan's semiconductors as the essential component, the golden screw without which their production grinds to a halt. If we add up the total market capitalization of the biggest customers for TSMC, Taiwan Semiconductor Manufacturing Corporation, we get to a total of close to $7 trillion. Could we move to the next slide, please? Thank you. What happens if an earthquake, real or metaphorical, takes Taiwan's semiconductor production offline for a year? Well, we looked at the output of sectors from smartphones to tablets to laptops to automobiles to home electronics, which rely on Taiwan's semiconductors, and we estimated what would happen to production in those sectors if they lost access to those crucial inputs. If we could move to the next slide, please. That exercise tells us that an earthquake in Taiwan would impose a cost on global GDP of around 4%, comparable to the catastrophic impact of the global financial crisis or the COVID pandemic. We can move to the next slide, please. How likely is that geopolitical earthquake to occur? Well, I think one thing is clear, and that's that putting precise probabilities on geopolitical risks is a tough thing to do. The background, though, is not encouraging. Let's look at what's happening to the composition of global GDP. As you can see in this chart, we're going through a grand reversal. In 2001, the advanced economies, the G7, accounted for 43% of global GDP, and the BRICS just 24%. Fast forward to 2040, and those shares will have reversed. The G7 share will have retreated to 20%, and the BRICS share advanced to 40%. Now, let's be clear, the economics behind this are positive. Good news, not bad news. The fact that billions of people in China and India and Indonesia and other emerging markets will be enjoying the benefits of stronger growth, higher incomes, rising prosperity is a positive, not a negative. At the same time, this transition is a dangerous moment for the global economy. A moment when emerging powers are flexing their muscles, a moment when established powers fear losing their grip, a moment when miscalculations can take place and crises which no one intended can break out. How do we hedge against those risks? Could move to the next slide, please. Well, here I would like to thank 52% of my fellow British people for giving us an example of how not to solve the problem of increasing geopolitical stress. When the UK voted for Brexit in 2016, we voted to leave the world's biggest single market. How's that working out? Well, it turns out that leaving the world's biggest single market isn't good for growth, as the Brexiteers told us, but rather bad for growth. As you can see in this chart, the UK economy is 3% smaller today than it would have been if that 2016 vote had gone in the other direction and we'd stayed in the European Union. Can move to the next slide, please. What would happen if other major economies, the United States, China, Japan, India, Germany, went beyond the specific measures they've taken to block trade and investment and engaged in a more thoroughgoing retreat from globalization? Well, there's lots of ways that could happen and lots of ways of measuring the impact. The big takeaway, though, from the range of academic studies which have looked at the risks from geoeconomic fragmentation is that the impact of a retreat from globalization would be significant and it would be negative. how about if we take a more targeted approach? Could we, as Hank Paulson suggested at the New Economy Forum in 2019, build a high national security fence around a small yard of critical technologies? Well, maybe, but as we can see from the US move to block sales to China of leading-edge semiconductors, that approach is far from straightforward. Yes, semiconductors have a military application, but they are also commercial technologies in use in everything from smartphones to automobiles. So should they be behind the national security fence or not? To me, the answer isn't clear. So before we get too gloomy, and perhaps it's already too late for that, but here we go. Before we get too gloomy, let me point out that there are winners as well as losers from increases in geopolitical stress, opportunities as well as risks. Workers in Arizona, in Dresden in Germany, in Kyushu Island in Japan, are cheering the arrival of billions in investment dollars as TSMC diversifies its geographical footprint. The economies of Mexico and Vietnam and others are benefiting as trade starts to flow through new routes, avoiding geopolitical fault lines. Investment in infrastructure and innovation in the United States is undergoing a generational increase as Washington, D.C. attempts to prep the US economy for the challenge of intensified competition from China. And when we snap open the new Huawei smartphone, we find a more advanced and domestically produced semiconductor. Perhaps competition with the United States is in accelerating the pace of innovation in China. Joe Biden and Xi Jinping might not be able to solve the big problems when they meet at APEC, but as you're going to hear from our next speaker, who's going to talk about a coalition between China and the United States in the fight against cancer, even if we can't solve the really big problems, there's still some important things that we can do together. There are winners as well as losers from the increase in geopolitical stress, opportunities as well as costs. The big picture, though, is a troubling one. And that means we have lots to talk about, lots of problems to solve at this year's New Economy Forum. Thank you.